Welcome to the Concierge CPA. I'm Jackie Meyer, founder of TaxPlanIQ software. This is a podcast for accounting firm owners and influencers who are pursuing world-class service. Let's go, y'all. Hey there, I'm Dr. Jackie Meyer, CPA, and welcome to the Concierge CPA Podcast. Before we dive in, here's something exciting. TaxPlanIQ users are saving their clients an average of $40,000 in taxes per taxpayer while selling large tax plans. TaxPlanIQ is the ultimate resource for tax advisors. With nearly 500 firms on board, we're helping advisors build skills, grow confidence, and connect with a vibrant community. Want to learn more? Visit taxplaniq.com/podcast for exclusive discounts, resources, and other things mentioned in this episode. Now, let's jump in. Welcome. Dr. Jackie Meyer here, CPA on the Concierge CPA Podcast. We're going to do something a little different, kicking off with this podcast episode where we start with a little bit of witty tax news. Then we'll do our wonderful guest interview, and we'll end with a lightning round of Q&A. So hang tight for that. It should be fun. But let's talk about the news real fast because there's always fun stuff going on for tax professionals. Number one, the IRS is expanding their free file program. Should you be worried? Are they going to replace us as professionals? Well, they are offering a pilot to 12 states for simple returns, but will that cut into your business? Probably not, because let's be real, clients can barely find their W-2, let alone navigate tax law changes. But it's definitely worth it to keep an eye on the IRS as it tests that. Number two, clients are complaining about smaller refunds, and here's why. So people freaking out about refunds are averaging down about 5.1% difference than last year, which can add up for lower middle income taxpayers. It's fewer pandemic era credits, adjusted tax brackets, and inflation are all to blame. So when your client's asking, where's my refund? Just pour another coffee and prepare your best calm but exhausted response. Number three, the IRS hires 3,700 new auditors. Sleep well, everybody, right? No, I mean, they're going to target high earners, complex business filings, but let's be honest, the audits do trickle down. If you got clients with questionable deductions, looking at you, those people claiming guard dogs for their self-employed business, it might be time for a gentle but firm conversation with them. And that is our new tax news segment. I'd like to welcome our second-time guest, David Podell. And David, any thoughts on that tax news? Or are you ready to dive into our interview?
Surprised you didn't bring up the BOI issues that are non-stop, right?
Yeah, I posted on LinkedIn the other day. Those make me want to barf. I don't want to ever hear the words BOI again. So I'm trying to just avoid that conversation altogether. All right. Well, David is the founder of Business Benefits Consultants with over, 2 decades at least of experience. You've really been a trailblazer in the tax planning space. Tell our listeners, if they didn't happen to catch your last interview with us on the Concierge CPA, tell us a bit more about you.
So, been a financial advisor, have a totally separate RIA for over 20 years. We are in the consulting space, dealing with all different designs and different retirement plans. And I believe today we're going to talk a lot about, based on, from our last podcast, we got into some other details. Today we want to make it a little bit different. And we're going to talk more about how, if you don't have a retirement plan and you're not putting clients in retirement plans, how that is beneficial from a tax strategy standpoint. And also it plays into the, is the IRS replacing us model of moving into what you love the most, which is advisory and charging for advisory services and charging for value. Well, retirement plans are a value piece. And if you can get your clients into these types of plans and get them to put money away, not only is it good for their retirement, but it's great from a tax standpoint for those deductions.
For sure, yeah. So David and I have known each other for many years now. He's always been very supportive of our causes over here at TaxPlanIQ. I don't know this statistic off the top of my head, but I know people significantly under contribute to retirement plans in general. Do you happen to know one of those numbers off the top of your head, David? Is it like 3 out of 4 people are not capping out their, or probably more than that, that aren't contributing as much as they can to retirement?
I don't know because we're more in that space of people getting these plans set up and then having them as business owners or solopreneurs, where the statistic would be interesting on those that are in corporate America and just getting W-2s, have a retirement plan, but aren't taking advantage of it. Now, I know there's new auto enrollment rules, so people are getting automatically enrolled, that they just, signing up for a new company or new job, they then would need to go in and bring their contribution down rather than sign up. So the auto enrollment rules is definitely going to help participation on all levels, because it's another step for somebody to go in and stop their contributions rather than telling them to go in and take more money out of their paycheck.
That's a great point. For listeners or viewers that don't know a whole lot yet about the auto enrollment, can you tell us a little bit more about that?
So we don't deal that much on that side because, again, that's on the corporate side. Our main focus is not on 401k plans that you get at your company or setting those up, but it's way more on the individual or the smaller company that wants to go and
Got it.
plan
Yeah.
a
So the auto
retirement.
enrollment is it, I think it might be mainly for employers with over 50 employees. And so it's the much bigger corporate environments that are heading towards that.
There's also states like California, for example, where you have to have a 401k now. It has
Oh,
to get put in, and you can use the state sponsored plans to do that. But it's the governments and the states saying retirement's a problem, Social Security is a problem. If we get people to take on that responsibility on their own, it's going to help it's going to help the government with the Social Security problem.
interesting. Okay. So my best friend, my BFF ChatGPT just gave me a few statistics from a few years ago. So in 2022, nearly half of American households had no savings in retirement accounts. So IRAs, 401ks, pensions. Older adults, 50 and older, about 20% had no retirement savings. That's alarming. Over half are concerned or were concerned about having sufficient funds to support themselves. And then lower income workers, which, I mean, this makes sense because you're in a cash crunch, but 75% of full-time workers are kind of in the really bottom 2 tax brackets lack access to retirement plans, compared to 17% of those earning more than like 170K. So that kind of gives us a general feel for where things stand. But you're right, it will change, hopefully, and evolve for the better with some of these mandates, although I bet some people aren't too thrilled with being, required to contribute to a 401k. Uh, any other thoughts on that?
They could opt out if they're not. Yes, it's the companies don't want to put it in because it's that cost if they don't have to.
Uh-huh.
And an employee can opt out and they don't have to contribute. What the reason that you're seeing that change, or that's continued to shift, and why there's not these private retirement plans, is because we're still dealing with the old pension plans from big corporations that used to take care of people.
Uh-huh.
And that obviously doesn't exist anymore. Everything went from defined benefit to defined contribution in the larger space. So with defined contribution, it's now the employee's responsibility to put money away. Anyone's leaving free money on the table if they're not putting money away where they're getting a match,
Yeah, for
because
sure.
that is just it's free money. It's part of a benefit, and it should be done. Then again, depending on the income, makes perfect sense because things are expensive, and no one wants to see a reduction in their paycheck. What's very interesting too that's happening, and I think this is great, is there is an automatic increase. So if you are working for a company and you have 1% of your check going away for retirement in the 401k plan, you can automatically set it up so it goes up by 1 or 2% every year.
Hmm.
So it's and you're not touching it, you're not changing it. So, and there was this old statistic that I heard where people spend way more time, or most of their time, hours and hours planning for a vacation than they do looking at their retirement plan in a year.
Wow.
So if you go and you increase your and you put on this automatic increase, if you have it, that's a huge benefit because you'll wind up at some point maxing out that 401 and won't even realize that you've continued to defer all those years.
Mm-hmm. Yeah, that makes sense. Um, wow. Okay, a lot to unpack there, but I think the things that I would say to someone if they're like, I don't believe in retirement or I need more access or liquidity to retirement funds is contribute up to that match, right? Because it's free money, like you said. And then if you're in a plan, you can take an up to 50K loan from your 401k. That's always a great idea. Some of them do, some of them don't. Or there are, non penalty type ways that you can get the money out for certain matters, like first time home, I believe, and higher ed. So there maybe like just work the system, right? Get what you can up front and then work the system on the legal ways on the back end that you can utilize the funds as well.
Yeah, we're big believers in leverage and using money for things. So uh, I encourage clients to take those 401k loans if they're using it for another investment. If
Yeah,
it's
for sure.
a, you know, new bathroom or a vacation or something else, that's really not a good way of using those funds because they're coming out of the market. You have to the interest you pay back to yourself, so it's a good deal. But if employment ends and you still have that balance, you have to either pay it back or the taxes and the penalty are going to get imputed to you at that time.
Uh-huh.
So it's not good if you're not paying it back. The reason a lot of people don't like it is because if you have a payback schedule of, call it $1,000 a month, you're probably going to say, well, I can't contribute to my 401 because I'm paying for the loan repayment.
Yeah.
So that sets you back from retirement because now you're just paying the money that you took out back and not contributing. If you could do both, it's a win. And if that 50,000, the max that came out at 25% of the value up to a max of 50,000, if you did take that out and you put it into another investment that you felt was going to yield some type of return or diversify you, such as real estate, then it is beneficial.
That's a great point. Yeah. Always want to leverage those interest rates and what the cost benefit is for sure. This is probably TMI or too much personal info, but I actually had an old retirement account that had like 300K in it. And I decided to roll it in a self-directed 401k, which we can explain what that means to people because I wanted to invest in real estate or alternative investments, right? Well, it was sitting there and I was waiting and waiting and waiting for Fidelity to put it in a like brokerage account to reinvest. And my husband works at Fidelity and has been a financial advisor for over 25 years. And he says that we lost out on probably 50K worth of increase in the stock market with it just sitting there doing nothing. And so the opportunity cost of not investing those funds is like so high, isn't it?
Yeah, we had a client that did something similar. They left their company. They had a few $100,000. They wanted to go into real estate deals, and they moved it over to a um, a self-directed trust type company. It sat in cash, and they never found anything. And I think it was like a year or two later, very similar situation where he said, I didn't invest any of this and was all gung ho. Here's my money. It's for real estate, to put it in there. So, yeah, it should be always working for you. It's retirement money, it's long term, and using real estate inside of a qualified plan, it's a whole nother conversation, but it is doable.
Mm-hmm. Yeah, for sure. There's a lot of catch-22s and IRS restrictions around it, but it is definitely doable. I think people don't realize that you can do self-directed IRAs and 401ks. So just know that if your clients want more control over their investments, then that could be a way to go. Okay, so that took us kind of way off the course of our topic today, but I thought that was all really interesting information. Let's hone in on a very simple retirement plan, solo 401ks. That's one of my favorite basic tax strategies. So what I would do at my own CPA firm, I worked with high net wealth executives that were leaving corporate environments, starting their own entrepreneurial journeys. So they had this small, C corp or pass through entity, and like the very first thing you'd want to do after entity selection, which is a strategy that everyone should be doing, is figuring out what the defined contribution plan looks like, right? And I love solo 401ks because you can put both spouses in it, which is great. And if they don't have other employees, it's got a way bigger contribution limit than a SEP or simple. I don't know why anyone does simples, honestly. I'm not a fan of them at all. But you can tell me if I'm wrong. And so, you're looking at what, 65, almost 70K that you can contribute total to this solo 401k each year. And then you've got the opportunities to put even more on top of that with like different types of defined benefit plans and that kind of thing too. Did I say all that right?
Yeah. And it is a great point. We used to see a lot of simples and SEPs, and you still do, because people in general don't want to. When you hear 401k, they think I need a third party administrator. I need all the complexities. There's all these things around it that I don't want to have to deal with. And you can just go and do a SEP plan. You don't actually need to file a 5,500 until you have 250,000 in assets. Another thing with the 401, and I don't believe on a solo it's needed, it might be, but you do need something called a fidelity bond, which basically ensures on a solo.
So no, you don't need it on a solo, but you do need it for even a small group plan, because we just did that for TaxPlanIQ last year, and I know we had to do that. That was a surprise.
Yeah, and it's a small amount of money, but it has to be checked off on the information, has to be on the 5,500. The purpose of that bond is if you have an employee and that employee is handling any of these funds or the contributions, and there's some kind of fraud that goes on, it basically pays out and helps to protect against that.
Okay.
So it's a mandated thing. On a solo, you're not going to need something like that because it's just you. You also wouldn't need to file that 5,500 for a certain amount of time. We do think someone should always have a plan document. You don't really need to have one. You could just go to one of the brokerages like a Schwab or Fidelity, Vanguard, and get something set up without all the plan document or 5,500 type work. If you decide to use those things just to have them and be more compliant, just, should it ever get looked at, you're looking at small fees like, $300 to $500. Some of these things, might even be $100 to $200 to do, when you do get to that 5,500 point to do that work. The cost for a TPA on doing that kind of stuff is very low. Excuse me. One of the things that we have seen problems that as a problem that should be considered is people will have a solo K, and then they bring on an employee. That employee is eligible, and they never change that plan. That plan needs to get changed to a plan that allows for employees' contribution and is not a solo anymore. And that's when you need a document, a 5,500 fidelity bond. So I think that's where sometimes people get afraid, where they're like, well, I want to do this, but what if I hire somebody? yes, things change, but that's also not a big cost or a heavy lift to put any of that in place. It's very simple.
Mm-hmm. Okay, that makes sense. And I can't go without mentioning the Secure Act 2.0. It actually gives small employers credits for 100% of like setting up a group 401k and then actually contributing like up to $1,000 per employee. So there's like who wouldn't want to take advantage of that? Like obviously, yeah, you have to keep a 401k going, but it does go for a few years. And so if a listener does have someone interested in retirement plan, now is kind of the time with some of those government incentives that we have going on, right?
Yeah, it's interesting. We send those out to everybody. We let them know about it. We tell them to do it. They have to do it direct. It's not something that, we could do or anyone else could do. Most people don't take advantage of it. Even if they know about it, it just becomes like another thing to do or more work, but it is government money that they're giving them to do this, but
Yeah.
they don't take advantage of it.
Well, that's where a good tax advisor comes into play because I get excited about these things. I took full advantage of it. I think we probably maximized about $15,000 we'll get back from the government for TaxPlanIQ to set up a group 401k plan late last year. And the employees are much happier because you're contributing, you started a new plan. So, I mean, those little things are what really add up, I think, in being a really good tax advisor. So, please, please, please explore this for your clients if you haven't already. Hey, it's Dr. Jackie. Are you enjoying today's episode? If you are, here's how you can support the podcast. Like, share, and subscribe to the Concierge CPA Podcast to help us reach even more listeners. Continue the discussion and connect with other accounting professionals in the Accounting Firm Influencers Facebook group or follow me on LinkedIn. Thanks for listening, and now let's get back to the show. Now, can you explain in kind of simpler terms why can you put so much more into a 401k than you can into a SEP or a simple? I mean, it's literally just kind of the limits that were initially set on those accounts, right?
Yeah, and they go up every year and they change every year. And yes, 401 you could get more contribution and you have two parts to it. You have the employee part and the employer part, which is essentially your deferral as an employee off of the W-2, and then your profit sharing component is employer contribution, which comes from the company. Both have separate rules and formulas and everything else. What I do like about the 401 too, besides the loan provision, which allows access, right? Where you don't have that with an IRA. You can't take a SEP with 500,000, $1 million in it and take any money out of it as as a loan and use it. Every business owner or any self-employed entrepreneur wants access in some way to their money. This allows, I know it's not a lot, but it allows for that 50,000 at some point to be able to be removed, taken as a loan, and used. There's that. And then the thing that I love the most about the 401 is you have a Roth component. So if you do not need a deduction 1 year, or you want to split the contributions, you can actually use the Roth component where generally you're not going to be able to put money in a Roth IRA. Here, this is allowing you to put away after tax dollars, defer it, never pay taxes on it again.
Yeah. Are you a strong believer that everyone should get as much money into a Roth as possible, no matter kind of income levels or what?
No, I don't have a rule of thumb for it. I think everybody is different. I think everybody's mindset is different too, where you might have a business and you're, in a really high tax bracket because you have great profits. We see that all the time and at some point that business will not be there. And I wouldn't speculate where profits are going to be, where tax rates are going to be, but you're most likely at some point not having that business. So are you in a lower? Are you in a higher? It's always good to be on both sides of the tax fence if you could. But it just depends on the person. And you have some people that are married with a spouse that has a really high income and they, they need that deduction, or the business has great profits and you need the deduction, or you could take half, take half of it and put half in Roth.
Okay. So that leads me, I didn't mean for this to be a leading question, but it does lead me to how do you plug into this equation to help people, right? So instead of I have a client, started a small business, considering retirement planning. Where do you plug in? Walk us through a typical engagement and the benefits of like putting you in the middle of that transaction versus just being like, okay, I'm going to go set up a solo at Fidelity.
Yeah, so we have a consulting company where we get involved to figure out everything about the client, what they are trying to do, what the future is going to look like. Are we ever going to have an employee? Are we not? Do we need a TPA? Do we not? So we'll kind of advise on that end. If we need to just set up an investment account, we'll go to our arm, which is totally separate and of financial planning advisory. Or we'll stick in the consulting side and really help to get that going and help in any way that we can. So it's bringing all the resources, having the knowledge, and just running those cases through us to see where and if we can provide value. We also have a large expertise in those types of plans when you go beyond this and you continue to grow and you need something that's a much bigger deduction, something in the range of $100 to $1 million, and going into some more complex type of designs.
Sure.
So we have those resources and ability. A lot of times we'll get a call, we'll meet with somebody, and it's not a qualified plan. We'll look at that and say, this is a deferred compensation type of design. This is something that should be done as a non-qualified deferred comp, rather than 401, SEP, simple, DB, whatever it is.
Okay.
So we're able to kind of pivot each way, knowing the industry and knowing what would work for those business owners.
Very cool. Okay. And so what practically is the investment that someone spends on you to have your help with us?
It really depends how complicated it is. If it's a solo K, well, then we're using our investment arm and we're not charging any kind of consulting fees or anything else. We really want to help a tax advisor get a client to a point where they have everything kind of set up and the ability to grow with us over time. And then as those things get more complicated, then we have certain fees and investments and costs to handle that.
Yeah. Awesome. Okay. I'm trying to think if there's anything that people misunderstand about solos or 401ks in general that we haven't already discussed. Can you think of anything else, kind of things that people tend to make assumptions about that they don't know about or we need to clarify?
I think the number one reason why I hear that someone's not doing this is because they don't want to lock their money up and they don't want to make commitments. Defined contribution does not have a commitment. So you can put in and you can max out, plan out 1 year, and then the next year go and use the money to expand your business or buy a competitor, do whatever you want to do. Putting money in these retirement plans pulls money out of the business and creates a personal net worth. And that's what I like about it. You're creating a personal net worth with the defined contribution plan. You're increasing and what we see on exit planning is most business owners, all that money is sitting in the business and they're, banking on that one thing. And a lot of times that works out. Get a huge buyout, a huge check, it's over, move on to the next. A lot of times that doesn't work out. More often it doesn't happen that way. And they're continuing to work and they have ups and downs in a business at some point. And having a net worth or plan outside of the business and being able to remove money on a tax-free basis is very beneficial.
Okay, that's great. I think one thing that just came to my mind is that even like Schedule C sole proprietors can do solo 401ks. I never understood why, because they're not technically employees, but I know brokerage accounts, they will set that up. And so there's a lot more leverage and access, I think, to these than people even realize. And I guess just for one quick case study, let's say that someone has a choice between different defined contribution plans. We've got the simple, which is limiting to what, $17,000 a year. We've got the SEP that's limited to 20 to 25% of their W-2 comp or net Schedule C income, right? And then we have the solo or 401k, which, like you said, is doing not only the employee portion, which is 20K plus, and over 50, they got is it 50 or 55 where they get the extra?
Yeah,
50,
50.
perfect. Yeah. So they've got that like 20, 25K employee, and then they've got another match, which can be flexible, right? There's ways to kind of supercharge what the employer matches versus it just being like only like 3%, right?
Yeah, and if you go and if you have employees, if you bring on an employee, you're not going to put in the document's going to get changed. It's not going to be solo anymore. It's going to now, adhere for employees, but you're probably not going to put money in the profit sharing component anymore. You're generally going to only do, when you have employees, the employee portion. The reason that now you have the option to, most people do not do that second employer portion when they have employees, because the percentage that they have to give to employees is higher.
Got it.
And that's why when you add, you really take a step up from there to determine, how much of a deduction do I need? Because then you can go into the defined benefit realm. And when you do so, you now have the formula changes, and you can do certain things to kind of tilt the scale in the way of the owners or partners rather than the employees.
Yeah. Okay. That totally makes sense. I know that I had a client once that, they were on the safe harbor plan. I never really understood what that meant. I don't know if that's silly of me, but it's where the owners could contribute more to the defined contribution plan or the 401k than the other employees. What does that mean, safe harbor?
So when there is a match that equalizes a formula, so there's 5 employees, what Department of Labor, IRS, what everyone wants to know is, are we taking care of the employees? Are they getting enough benefit out of this? This is not now a plan that is meant for only an owner. This
Okay.
is now a plan that is meant for employees, not an employer. So when doing so, and you add a certain match on there, 3, 4%, there's different formulas that can be used. But when you add this safe harbor match on there, you're basically saying, this is going to pass testing because I am willing to give a benefit in a form of a match to my employees should they contribute.
Got it.
Sometimes there's a match that's, I'm going to contribute automatically to everybody, and sometimes there's a match that you only have to contribute to those that also do contribute. If you have employees or if you have a client with employees, there are so many different options. I would say talk to us. We want to gather that information and then figure out what's the end goal here. If the end goal is for the owner to have that deduction and take a bigger deduction, and this not really take care of employees, is not meant for employees, well, that's when cash balance, defined benefit, and those other things need to get combined into this to do that.
Got it.
But
Okay.
safe harbor, without a safe harbor or without a match, you really can't max out because the plan will test to become what's called top heavy,
Mhm.
where the people making the most money, example, the owner, is going to then be able to max out, and it becomes an unfair advantage to the employees. Where when you do have that match on there, it equalizes things.
Okay. Awesome. Awesome. I think that we've covered a lot of like tips and tricks of things that people don't really think about. Is there anything else before we kind of conclude with the interview portion of our segment here that you wanted to cover?
I think we touched on all of it plus more, right?
Awesome. Okay. Yeah, I really appreciate it, David. I know you are one of the sharpest advisors I know. I've always really appreciated how detailed you get with your work and how much passion that you have to it. How would someone reach out to you to just have a chat about potentially working together?
Our website's the best way. There's resources, businessbenefitsconsultants.com. Best way. And on there's scheduling, there's contact information, there's resources. So that's going to be the best outlet.
Beautiful. Yeah. And then David is our preferred vendor for 401ks in TaxPlanIQ. And so you can find his contact information in there in the preferred vendor section, along with a ton of other resources as well, if you are a user of our software. Okay, so on that note, we're going to go to our new segment. I have no idea how this is going to go, but I think it's going to be fun. Rapid fire round or lightning round. And I'm going to keep the questions pretty darn easy, David. Okay. And I'm going to let you answer, and then I'm going to answer too. I'm not sure if I'll answer in the future. I might just focus on the guests, but we'll see. So are you ready for it?
I'm ready, I think.
Okay. He's like, oh boy. All right. Coffee or tea?
Coffee.
Same. Funniest client tax deduction you've ever heard of?
I need to think on that. I don't.
Okay, I'm going to go with people wrapping their car with their logo and thinking that makes the car 100% deductible, because I already mentioned the security dog earlier. So yeah, you can circle back to that one.
I have seen the watch collection. They try like a write-off on a watch collection by
Wow.
creating like a YouTube channel that talks about watches or something.
Oh my gosh, that's interesting.
Yeah.
Okay. They might have gotten away with that because there's a lot with personal influencers now that can do those kind of things.
It could be. I'm not saying that it's wrong.
Right. It's just very different.
Funniest, that I thought that was clever.
Yeah, very cool. Okay. One retirement myth you want to bust.
That in defined benefit or cash balance plans, you have to make the same contribution every single year.
Yes. Those are way more flexible than they used to be. I would just say don't overlook the simple stuff. If people know what the acronym KISS means, keep it simple. You know what? I hate seeing people overlook basic tax strategies that can still add up to tens of thousands a year when to go for like the big stuff, So tax planning is tax planning, whether it's a 401k setup or something more complicated. All right, let's see. This is a funny one. If a solo 401k was an animal, what would it be?
Should have sent me these before.
I mean, that's the weirdest question. I had ChatGPT come up with these, which I'm loving it. For some reason, butterfly came to my mind, but ChatGPT suggested that you say a lion because it's powerful, efficient, and underestimated. So there you go, David.
Okay.
What's the biggest retirement planning mistake you've ever seen? Not doing it?
Well, not doing. Yeah, that's a good one. Pertaining to this, it's years and years could go by and people will not they won't get a TPA or they won't file a 5500, and there's so much money in the plan and they have to go back on all those things. Or just pertaining to solo K, hiring all these employees and the owner still continues to put money in that solo K as if it didn't need to get revised and offered to those employees. And there could be millions of dollars in the plan and the employees were never offered. And you have to go back and give all these benefits to employees. It's a huge mess.
Oh my gosh, that sounds awful. And I've seen it before too, and it's just the worst. I mean, payroll type mess ups are the hardest thing to fix when it comes to the IRS. And, retirement contributions is all on that W-2. And reportable on the returns, obviously. And so there's a lot of compliance that goes along with it. That's why someone like you is so important to look at it year to year, right?
Uh-huh.
Okay, awesome. Now, best piece of advice you've ever received?
Yourself is your best investment is in yourself.
Oh, I love that. I love that. Okay. What comes to mind for me is my mentor and co-coach, Chuck Bauer, who you know. He says, well, I butcher his lines, but you get the gist. It's like, stop thinking, start doing. That's when I became an extremely successful entrepreneur, is when I stopped overthinking things and I started actually just doing them. Because if you have a vision without the implementation, it goes nowhere and you get. So yeah.
What's
Awesome.
what's the saying, or it's a book, like fire, ready, aim?
Ah, yes. Now, yeah, that sounds super scary to us accountants, but there's definitely some truth in it. Awesome. Okay, well, I'm letting you off the hook. I think we did a very good first lightning round. What do you think, David?
Great.
Awesome. Okay. I appreciate you listening all the way to the end. It truly means a lot. As a thank you, I'd love to give you a free gift, my value pricing calculator and proposal workbook. This tool has helped tax advisors create 8-figure tax plans and save over $1 billion for their clients. You can now download it at taxplaniq.com/ROI-method. Thank you for being part of this journey, and I'll see you next time on the Concierge CPA Podcast. Take care, y'all. Thank you for listening to the Concierge CPA, hosted by TaxPlanIQ. We believe that every person has a unique message that can positively impact the world. If you are a successful accounting firm owner or influencer who would like to be on this program, please visit JackieMeyerCPA.com, JackieMeyer CPA.com to apply. Please share this on social media and rate us so we can continue our good work. Join our Facebook group called Accounting Firm Influencers, or connect with me on most platforms under Jackie Meyer CPA. Thanks for being accountable to transforming our industry today.